Markets are distracted. Headlines are loud, filled with politics, tech stocks, and the latest Fed whisper. But behind the noise, something far more dangerous is unfolding. The United States is quietly positioning itself for what would once have been unthinkable, a default on its national debt. Not a full-blown collapse, not a press conference admitting total failure, something quieter, something technical, something that looks like a fix but feels like the beginning of the end. Let's break it down. Right now, the U.S. national debt has soared past $36.2 trillion. That number isn't just big, it's historic, it's unsustainable, and what's worse, it's accelerating. In the last 12 months alone, the U.S. added over $2 trillion in new debt. That's more than most nations generate in total GDP. Interest payments are now one of the largest single budget items in the entire federal government. Over $800 billion a year just to service existing debt. That means America is now borrowing money to pay the interest on the money it already borrowed. And behind closed doors, officials are beginning to prepare for the worst. Earlier this year, the debt ceiling was reinstated at just over $36.1 trillion. That means any new borrowing is technically illegal unless Congress acts again. And while the Treasury Department is still issuing short-term T-bills, many experts believe these are emergency liquidity maneuvers, not long-term funding solutions. There's more. Insiders have leaked that the Treasury Borrowing Advisory Committee, or TBAC, has discussed payment prioritization options. That phrase might sound boring, but it's code for something much more serious. It means that in a crisis, the U.S. government could choose to pay some bills while delaying or skipping others. That's not a balanced budget. That's triage. If that ever happened, it would technically count as a selective default. Credit agencies wouldn't care how many bills got paid. If even one legally required obligation is missed, that's a red flag. And Moody's, Fitch, and S&P have all issued quiet warnings. They're watching. So what would a technical default look like? It wouldn't be dramatic at first. The dollar wouldn't crash overnight. Markets might even rally, believing a deal is close. But behind the scenes, the cracks would deepen. Bond yields would spike. Confidence would erode. Foreign buyers like China and Japan would begin liquidating treasuries, and that's already happening. Over the past year, both nations have reduced their holdings of U.S. debt, not in a panic, but in a slow, methodical unwind. It's a quiet exit, the kind that precedes major reallocation. Why does that matter? Because the U.S. relies heavily on foreign buyers to absorb its borrowing needs. If they step back, yields must rise to attract new money. And when yields rise, so do interest costs. It becomes a self-reinforcing spiral. At some point, the math stops working. And that's when policy shifts begin to happen quietly. The Federal Reserve, despite publicly avoiding politics, has already run simulations on potential liquidity triage scenarios. They don't call it default, but that's what it is. Emergency systems have reportedly been tested to ensure Social Security payments, military salaries, and Treasury bond redemptions are prioritized. It's a contingency plan, but the fact that such a plan even exists should terrify you. Here's the worst part. None of this is being debated in Congress right now. There's no active conversation about how to structurally reduce the debt. No new revenue models, no bipartisan agreement on reform. Just silence. It's as if everyone knows what's coming, and no one wants to admit it. The game now is delay. Borrow more, refinance later, and kick the can while praying the music doesn't stop. But the music is slowing. Inflation may be down from its 2022 peak, but core prices remain sticky. The Fed can't slash rates without risking another wave of price surges. And without lower rates, the cost of debt remains high, which means every new borrowing cycle digs the hole deeper. There's a growing sense among top economists that the U.S. will eventually need to restructure obligations. Again, that's polite language. What it means is default, but with branding. They might call it a policy adjustment. They might use terms like delayed maturities or rollover ceilings. But it's still default. And the rich, they see it coming. In the last 6 months, billionaire hedge funds have been repositioning aggressively, shifting into hard assets, gold, energy, and strategic real estate, reducing exposure to long-duration debt instruments. They're not betting on collapse, they're hedging against denial, because denial is the most dangerous phase of any economic cycle. And right now, America is in it. The political theater continues, the market's cheerminer wins, but beneath it all, the structure is cracking. Let's zoom out. What would happen if a true U.S. debt default occurred? Treasury yields would spike. The dollar would drop sharply in international forex markets. Global credit markets would seize. And every major bank on earth would face margin calls because treasuries are used as collateral in trillions of dollars worth of global lending. A U.S. default would be like removing the keystone from a bridge. Everything else begins to buckle. Some argue that can't happen, that the U.S. has too much to lose. But the truth is, it already is happening, slowly. The preparation is real. The systems are being built. The risk is no longer theoretical. And yet, almost no one is talking about it. That's not an accident. Governments rarely announce emergencies. They prepare in silence, hoping the storm passes before the public catches on. But hope is not a strategy, and the numbers don't lie. When interest payments approach $1 trillion per year, the margin for error disappears. When 30-year bonds carry negative real yield, investors begin to flinch. And when foreign buyers walk away, the game changes entirely. You are not supposed to know this. You're supposed to believe that debt doesn't matter, that America always pays its bills, that growth will magically solve everything. But math has no ideology, and compounding interest doesn't care who's in office. Right now, the most powerful nation on earth is walking toward the edge with its eyes wide open and its mouth shut. And when the moment comes, there will be no warning, no ticker alert, just silence. You'll wake up one day and realize the rules changed while you were sleeping. So stay alert, watch the debt, track the liquidity, and never forget, nothing breaks all at once. Until it does. If this opened your eyes, subscribe to Wealth Signal. We expose what others won't and help you prepare before it's too late. The warning signs are no longer subtle. Just last quarter, the U.S. Treasury issued over $800 billion in new securities, most of it just to keep existing obligations afloat. These aren't investments in growth, they're lifelines. And when an entire economy is floating on IOUs, confidence is the only thing holding the structure together. But confidence is fading. You can see it in how central banks are behaving. Over the last 18 months, they've been buying gold at the fastest pace since World War II. Not because they expect war, but because they no longer trust the dollar to hold its dominance. You can see it in corporate debt markets where spreads are quietly widening. Risk is being repriced. The free money era is over, and the real cost of capital is beginning to reveal just how fragile the foundation has become. And you can see it in how quietly the conversation has shifted. Nobody's laughing off default anymore. They're just avoiding the word. Don't wait for the media to confirm the collapse. By the time they do, the doors will already be closed. Act early, stay sovereign, and read the signals before they scream.